When Maria lost her job at a local restaurant, she faced a critical decision. Without a bank account, she couldn't apply for unemployment benefits via direct deposit. Instead, she received paper checks that cost her $10 to $15 each to cash at a check cashing service. Over 6 months of unemployment, these fees consumed nearly $300 of her limited resources. Maria's situation illustrates a challenge faced by many low-income Americans. According to research by Claire Sellerier and Adrien Matray, nearly 40% of people worldwide and 30% of low-income Americans are unbanked. They have neither a checking nor savings account. This financial exclusion comes at a significant cost, limiting their ability to build wealth and achieve financial security. Low-income households without bank accounts are at a serious disadvantage when it comes to building wealth, explains Adrien Matray, an economist at the Atlanta Fed and co-author of the study. Our research shows that simply having access to basic banking services can dramatically improve financial outcomes for vulnerable households. The banking gap. Even in economically developed countries like the United States, low-income individuals often remain outside the financial mainstream due to various barriers, including minimum balance requirements, high fees, and limited physical access to banks in low-income neighborhoods. To understand and quantify the cost of such a phenomenon, Claire Sellerier and Adrien Matray studied the consequences of the Interstate Banking and Branching Efficiency Act, IBBEA, of 1994, which allowed banks to expand across state lines. As states removed barriers to interstate branching, bank branch density increased by around 20% in poorer counties. This expansion of banking services created an ideal setting to study whether improved access to financial services actually helps people build wealth. The results were striking. The share of low-income households with bank accounts increased by 8%, and these newly banked households accumulated significantly more wealth than their unbanked counterparts. Building wealth through financial inclusion. How exactly does having a bank account help build wealth? The study identified several key pathways. First, bank accounts provide a secure, interest-bearing place to save money. While the interest rates on basic savings accounts may seem modest, they significantly outperform keeping cash at home, where it earns nothing and risks theft or loss. Second, financially included households invest more in durable assets, particularly vehicles. Having reliable transportation expands job opportunities and earning potential, creating a positive cycle of economic advancement. Third, bank accounts improve access to affordable credit. The relationship with a financial institution allows low-income households to build credit history and qualify for lower-interest loans for vehicles and other essential purchases. Perhaps most importantly, financial inclusion creates a financial buffer against life's inevitable setbacks. When households experienced a job loss, those with bank accounts were significantly less likely to face financial hardship or fall behind on rent and utility payments compared to unbanked households experiencing the same shock. Beyond individual benefits. The benefits of financial inclusion extend beyond individual households. When households can better weather economic shocks because they have access to a bank account, they're less likely to default on rent payments, benefiting landlords as well. They're also more likely to maintain spending during personal economic downturns, which supports local businesses and the broader economy. Our results suggest that unbanked households are constrained by the supply of banking services and can benefit from them, Matray concludes. In other words, many low-income households remain unbanked not because they don't want financial services, but because these services aren't sufficiently accessible. Policy implications. These findings highlight key steps for policymakers seeking to reduce poverty and strengthen financial resilience. Expanding access to basic banking services through new branches, community institutions, or mobile solutions should be a priority. Regulations must tackle affordability barriers like high fees and minimum balances. Finally, financial education should emphasize how mainstream banking supports wealth building compared to costly alternatives like payday lenders or check-cashing outlets. The path forward. Maria's life improved when a nearby bank offered no-fee accounts. She saved enough for a car within a year, boosting job opportunities. Later, her emergency fund helped her stay afloat during unemployment. Research by Sellerier and Matray shows her story reflects a wider truth. Financial inclusion builds resilience, wealth, and opportunity for low-income households.